I ranked all 34 Schwab ETFs to find one winner. Then the data actually handed me two, and they completely disagree with each other. One has the bigger number, the other has the better case, and picking the wrong one could cost you years. In this video, all 34 Schwab ETFs, $10,000 each, ranked over 1 year, and 10. Now, Schwab runs two different kinds of index funds, and the fight between them is the whole story. One kind won at home, the other won everywhere else. By the end, I'll show you the fund that turned $10,000 into $54,000, why the popular one fell short, and the second winner barely anyone talks about. Okay, so the setup's pretty simple. I'm running $10,000 through every one of these funds, same starting line across the board, and then just watching where they end up. And I'm looking at two windows of time. There's the last 12 months, which tells you what's hot right now, and then there's the full 10 years, which tells you what actually holds up when things get rough. Because look, any fund can have a good 1 year. It catches a wave and suddenly looks like a genius. 10 years is a lot harder to fake. So that's the stretch that really truly decides the winner here. Now, 34 is the full lineup, but a bunch of these funds are basically babies. Some of them only launched a couple years ago. So if a fund doesn't have 10 real years behind it, I'll show it to you, it just can't compete for the top spot. That knocks the field down to 21 funds actually in the running. One more thing, and it genuinely matters on a channel like this. Every number you're about to see is total return, meaning dividends reinvested, not just the share price moving. If you leave the dividends out, you're not really telling people the truth about what they earned. All right, here's the part that makes Schwab different from anyone else. Most of their funds are built the normal way, by size. So the bigger the company, the bigger its slice of the fund. But Schwab also runs a second set of funds, their fundamental ones, where the weight comes from sales, cash flow, and what a company actually pays out. Price doesn't come into it at all. So you've basically got two different philosophies from the same company, and they spent 10 years going at each other. We'll start with the boring one just to get it out of the way. Bonds. And yeah, I know, nobody clicked on a video like this to hear about bonds, but 4 of them have 10-year track records, so they're in the test whether we like it or not. And I'll keep it quick. The one that won was SCHP. The TIPS fund, TIPS, where 10 grand grew to $12,938. And there's a clean reason it came out on top. TIPS, or Treasury Inflation-Protected Securities, are built to rise with inflation. And this just happened to be the decade where inflation actually showed up and stuck around. So the fund did the exact job it was designed for. Right behind it, you've got SCHO, short-term treasuries, at $11,872. When the Fed started cranking rates up, these barely noticed because they mature so fast that they just roll straight into the new higher rates. Then there's the big one that a lot of people actually hold, SCHZ, the total bond fund, at $11,635. It owns a little bit of everything. And that's sort of the problem, because the longer-dated stuff inside it took a hit when rates climbed. And dead last, SCHR at $11,254, intermediate treasuries, which is kind of the worst spot to be in here. Long enough to catch the rate damage, but not short enough to bounce back from it fast. Now, a quick heads up on what you're seeing in that 1 year column, because it looks a little weird. A handful of younger bonds like SCYB, the high-yield one, actually beat SCHP over the past 12 months. SCYB put up a 7% year, the best of any bond fund here. But none of these younger funds have a full 10-year record yet, so as good as that recent run looks, they're not in the running for the crown. Riskier bonds, bigger payout. Just keep half an eye on them. But honestly, here's the real takeaway from this whole segment. Top to bottom, the entire range runs from about $11,250 to just under $13,000. That's it. 10 years of investing, and the gap between the best bond fund and the worst is barely $1,700. So bonds did their one and only job, keeping your money from shrinking. That's about all they did. Okay, now the part you actually showed up for, the funds that were supposed to make it grow, U.S. stock ETFs. This is the big one. Most of Schwab's real money lives here. So let's get straight into it. SCHG, the Large Cap Growth Fund. $10,000 in this thing 10 years ago is worth $54,114 today, and nothing else on the whole platform even got close. And the reason it ran away with it basically comes down to a single number. Almost 60% of this fund is sitting in around 10 companies: Nvidia, Apple, Microsoft, the names you already know by heart. So this wasn't really a fund that won so much. It was more like 10 years of big tech wearing a fund costume. And that's worth sitting on for a second, because it works both ways. As long as those same names keep leading, SCHG keeps printing. But if they ever crack, this is the fund that's going to feel it before anything else. It's a bet, even if it doesn't really feel like one when you're buying it. Now, if you step down a rung, you get SCHX, the large cap fund, at $41,354. And there's SCHB, the broad market one, at $40,107. Almost the same number, but SCHX squeaked ahead, and the reason is a little backwards. SCHX holds around 750 big companies, while SCHB holds something like 2,500. You'd think owning more of the market would help, but all those extra small and mid-sized names just watered it down this past decade. More turned out to be less. And hang on to that idea because it comes back. All right, so this is where the two systems actually start swinging at each other. Remember the fundamental funds, the ones built on cash flow instead of size? If you line each one up against its normal twin, it's a clean sweep. SCHX beat FNDX, SCHB beat FNDB, and SCHA beat FNDA. 3 matchups at home in the US, and the plain version took all 3. And it's the same story behind every one of them. The fundamental funds are designed to pull back from stocks whose prices have shot up past what the business is actually worth. And that exactly defines the mega cap tech that carried this entire decade. So being disciplined during the past 10 years, when the undisciplined bet won everything, that cost the fundamental fund approach significant gains. And here's a neat little detail. That same watering down effect we revealed a few minutes ago shows up inside the fundamental system too. FNDX, the large company version, beat FNDB, the broad one, for the exact same reason SCHX beat SCHB. The smaller stuff dragged. So no matter which way Schwab builds the fund, casting a wider net was a bad move during this particular decade. 3 for 3 at home. But hold that thought, because overseas, it falls apart completely. Then you've got the cluster of funds that got left in the dust, and they didn't land in a random order. SCHV, large cap value, came out top of the 3 at $30,078. Then SCHM, the mid caps, at $29,692. Then SCHA, the small caps, at $29,403. And if you watch the company size as you go down that list, it shrinks every step. That's not an accident. The mechanism behind it is pretty straightforward. When rates go up, smaller companies get hurt the most because they carry more debt, and a lot of that debt floats with interest rates. So the bigger the company, the softer the landing. SCHV held up best simply because it's the largest of the 3, and SCHA took the worst of it because it's the smallest. The whole value versus growth thing barely mattered here. It came down to size. And in a second, you're going to watch that flip on its head. But first, a couple of youngsters before we get there. SCHK, The 1000 Index Fund has no decade behind it yet, but it put up a solid 24% on the year. And SAEF is the one fund where Schwab actually lets a human pick the stocks instead of tracking an index, so it's interesting, just too new to crown. Bookmark both. Now flip over to the one-year board, and the whole thing turns over. SCHA, which was at the bottom of that cluster over 10 years, jumps right to the top at $14,108. And SCHG, our 10-year champion, well, it sinks almost to the bottom at $11,892. It's the same size rule from before, just running in reverse. The moment rate cuts came into view, the smallest companies, the ones that got hammered on the way up, bounced the hardest on the way down. The king of the decade became an afterthought for the year. So at home, plain beats smart, clean sweep. We're about halfway through this. In the end, I'll show you two winners that completely disagree with each other. Plus, the moment this whole test flips on its head. Both of those are still coming. But now, I want to cover a whole corner of the lineup we haven't touched yet, and it's where the fund everyone actually owns finally shows up. This is the income corner of the lineup. 3 funds here, and one of them is probably the most popular thing Schwab sells, SCHD. $10,000 turned into $33,466, and it won the category clean. But I told you from the beginning, the popular fund fell short somewhere, and this is where that story starts. The thing about SCHD is that it's picky on purpose. To even make it into the fund, a company has to have paid dividends for 10 straight years, and it throws out REITs and the other yield traps entirely. Which sounds great until you realize it means SCHD never once held Nvidia or Tesla or any of the names that drove the last 10 years. It sat out the entire AI rally basically by design. And even doing that, it still turned 10 grand into 33 on nothing but boring, profitable, dividend-paying companies. That's not a knock at all. Honestly, that's kind of impressive when you think about what it gave up to get there. The other real 10-year fund in here was SCHH, the REIT fund, Real Estate Investment Trusts, which managed to reach $15,543, so less than half. Real estate is about the most rate-sensitive thing you can own, and a solid decade of rising rates just repriced the whole sector, and hard. Oh, and there's a younger cousin in this group too, SCHY, the International Dividend Fund. No 10-year record yet, but around 23% over the past year. Tuck that one away because international is about to matter a lot. So sit with SCHD for a second. It beat every income fund in this segment. And in a minute, you'll see it beat almost everything else on the platform too, but it still wasn't enough. Just keep that number in your head. $33,466. SCHD proved that a quality fund can absolutely win its lane. Which got me wondering about something. What if you took that exact idea, discipline over hype, and pointed it overseas? Does the SMART system finally win? Watch this. Same two systems, brand new continent, and everything you just learned turns completely inside out. Back home, plain beat fundamental 3 times in a row, right? Well, overseas, FNDF beat SCHF, FNDE beat SCHE, and FNDC beat SCHC. 3 matchups again, except this time, the fundamental funds swept all 3. It's the complete opposite of what just happened in the US. And it's the same discipline that lost the race in America. The difference is there was no magnificent 7 over here, no little handful of giant companies running off with the whole market. So weighting by cash flow instead of price finally got rewarded, and each of these matchups paid off in its own slightly different way. Start with the crown, FNDF, the Fundamental International Large Cap Fund. $31,063 over 10 years plus a 41% return on the year, which is the single biggest one-year number of any fund that even qualified for this thing. It leaned hard into cheap European and Japanese companies, your financials, energy, industrials, which is exactly the stuff that led overseas markets while everyone in the US was staring in the complete opposite direction. Its plain twin, SCHF, owned the same regions but split the money up by size instead. So it just caught less of that rebound and landed at $27,151. Now, the emerging markets pair is honestly the cleanest example of why any of this works. SCHE, the plain version, has this problem hiding in plain sight. One single stock, Taiwan Semiconductor, makes up about 17% of the whole fund. One out of every $6 you put in is riding on a single chip maker. FNDE, the fundamental version, structurally just can't do that because weighting by cash flow spreads the money out across a bunch of cheaper companies instead of dumping it all into the most expensive one. FNDE came in at $28,686, SCHE at $23,314, and that one concentration problem costed about $5,000. And then the small cap pair, FNDC over SCHC, $23,310 to $21,897. Same value tilt, just applied to the tiniest, thinnest traded companies in the entire test. They finished last in the segment, but even down here at the very bottom, the smart fundamental version still edged the plain one. So here's what 10 years actually settled. It's not that the fundamental system is better, and it's not that it's worse either. It really just depends on where you point it and whether the market you're aiming at is already top-heavy with a few expensive winners. Same two systems, this time a win abroad and a loss at home. Which kind of leaves one question hanging over all of this. Of all the Schwab ETFs, which actually took the whole thing? So let's line up all 34 of them. Here's the top 5 over the full 10 years. SCHG, SCHX, SCHB, FNDX, FNDB. If you're noticing a pattern, good, you should be, because every single one is a big US stock fund. 3 of them plain, 2 of them fundamental. No dividend fund, no international fund, no bonds. The whole top of the board is just America's biggest companies, whichever way you could choose to weight them. And here's the part I promised you back at the start. SCHD, the fund you probably own, came in 6th. And I want to be clear about what that actually means, because 6th out of 34 is really good. It beat every other income fund, every international fund, every value, mid-cap, and small-cap fund on the platform. Only 5 funds beat it, and all 5 are sitting right there at the top, every one of them a big U.S. stock fund. SCHD is a genuinely great fund. It just ran into the one thing almost nothing could beat this past decade, owning America's biggest companies. For 10 straight years, that bet, in just about any form, was nearly unbeatable. Now, the recent picture, and of course, it looks nothing like that. If you resort everything by the past year, the international and small cap funds rocket straight up to the top, while SCHG, our 10-year champion, slides way down toward the bottom, which tells you something worth tattooing somewhere. Whoever's winning right now is almost never the same as whoever wins over a decade. The leaderboard moves around and moves hard. There's also one fund I kept out of the race entirely, and that's STCE, Schwab's crypto fund. It was up 68% on the year, the single biggest number on this entire board, but it doesn't have a 10-year history, and the swings on it are genuinely brutal, so it never got to compete. Biggest number in the room, but no history to really prove itself yet. So, two winners. And as I hinted at the very beginning, they don't agree with each other. If the only thing you care about is the biggest number, then the winner is schg, hands down. 10 grand into $54,114. But you already know the catch on that one. It's 10 companies in a trench coat. So if big tech keeps running, you look like a genius. But if big tech cracks, well, you're the most exposed person in the room. That's a real bet, even when it doesn't feel like one. The second winner is the boring one, schb, the Total Market Fund. It slid into third over the decade, and in doing so, beat every dividend fund, every value fund, every mid-cap, small-cap, and fundamental fund you might have been tempted to outsmart the market with. Also over the past year, schb did about 25%. Perfectly solid, but nothing that'd make headlines. It didn't win last year. It probably won't win next year either. It just never finishes near the bottom, and it compounds year after year. We went through all 34 to find the clever play. As it turns out, the clever play was the simplest one on the list. One of them got the bigger number, and the other got the better case. Now, you actually know which is which. So Schwab runs a tight 34. But what happens when you take this exact test to a lineup almost 3 times the size? I ran all 94 Fidelity ETFs through the same thing, $10,000 each, and one of them turned that into over $80,000 in 10 years. Different company, a lot more funds, and a winner that came out of nowhere. That video is on screen right now.